hey, we can actually power a whole new range of location-aware applications rather than building one ourselves. So we said, why don't we do that? Let's go and build that. So this is what we ended up with. This is what our technology actually does. So we developed a way to take geofencing or location awareness for smartphones down from an accuracy of hundreds of meters, at a minimum 100 meters for instance, iOS or Android, down to a 1 centimeter wide line. We can literally trigger an action when a user crosses that 1 centimeter wide line drawn anywhere without any hardware being placed. How much do you think it cost us to build this just to get it to the point of launch so it could be used by companies? Anyone?
3 million.
$1.5 million in 2 years. So that very rapidly changes the capital requirements for your company. We originally thought, we raised our first round was $225,000. We thought that's it. We can get the company, get the product out. Absolutely crazy. So this was a very big pivot for us. So originally it was powering tolling in 3 states, and then we said let's power a new standard for location services globally. So we managed to patch over $1.5 million while working with a lot of Australian angels. So we had a really good group of angels with us who supported us, and they came in, they reinvested multiple times, they kept giving us money, which was good, thanks. We also managed to leverage a lot of government funding, so commercialization, Australia grants, etc. So we managed to get to the point of release, and we said, okay, we've burnt $1.5 million, we've released the product, we need another $1.5 million, we think, in order to get traction, get customers, and actually build a viable business. So we said, okay, we've managed to raise from the Australian investment market to date $1.5 million. Let's just go back to it and raise again. But let's look at the Australian investment market currently. You have angels and VCs. Angels are really easy to deal with, low due diligence amount. You can raise pretty quickly from them. They give small amounts, so you have to patch over multiple angels in order to get around. On the other hand, there's VC. Now, VC, they invest higher amounts, but they have much higher criteria for your investment. Now, to understand why they're so risk-averse and why they need you to actually generate a lot of money, sometimes be cash flow positive before they'll give you money, all you have to do is look at the performance of the Australian VC industry previously and what kind of companies were actually building in Australia. So from 1985 to 2007, the net return on the Australian venture capital industry as a whole was minus 5.4%. Now, with that kind of returns, would you be dishing out money easily to any company? Probably not. So you can raise money early on in Australia from angels, later on with VCs, but what happens in the middle when, like us, you've built this product and you need more money to start actually acquiring the customers and you believe in the potential of the product? Welcome to the Valley of Death. This is a real thing. It's in Australia, it's very prominent, and it kills more Australian startups than any other phase or phenomena of company life cycles. So you have, at this point, justify, when you're down at the bottom, when you've just built the product and you're starting to acquire customers, you have to justify why you've burnt $1.5 million building the product. You have to justify to an investor why you need to continue the same level of expenditure as you go along in order to maintain the product, keep building features, and you have to justify why you have to increase costs in order to pump money to marketing and to sales, etc. So for us, we went to Australian angels and said, hey, we need another $1.5 million, and they said, keep dreaming. They said this is, no one can write a check size that big for an angel. It's really, really difficult, and it's a bit later stage in the company, so it's just a little bit too late for us. And then you go to the VCs, and the VCs were very friendly, and they sat down with us and they listened to our story. And as soon as they realized we're at the bottom of the Valley of Death, the answer was always the same: come back later when you have revenue traction, etc. So you're staring down a dwindling bank account, expenses are rising or keeping solid. You've gone to the Australian investment market, to angels, to VCs. You've begged everyone for money. When I say beg, I literally mean beg. And you've constantly got a no. So what do? You look at other investment markets. You have to. There's no choice. It's either shut down the company or look internationally. So that's what we did. We started looking at a lot of places where we could get investment. Now, this is just a pretty important chart for me. I'm just going to describe it a little bit to set some context. Now, this is adjusted per capita. This isn't based on the size of the market. It says that in Australia, we invest $4.09 per capita into the venture capital for startups. We spent $12 on our Olympic team per capita, $52 on Melbourne Cup bets per capita per annum. Israel spends 182, and Silicon Valley does 4,000 plus for venture capital per capita investments. What this means is that when you look internationally and how much other countries invest and the availability of funds there, it also means that the criteria for funding really, really drop. So what we did is we started looking at the US market. So we went and we went to the US market and we started looking at who can we reach, who can we speak to. Now, one thing that's quite important is that you use your networks when you're looking for international funding. If you call an email, and hey, I'm from Australia, no one answers your call, no one answers your email. That is the truth. And you need to network. So what we did is we started looking at contacts that we had, some in Seattle. They put us in touch with a couple of investors. One was based in Montana, I think, and the other one, can't even remember where. And also through an Australian contact, we met our chief investor, a major investor, a gentleman called Jeff Katz. Now, Jeff presented a really, really good example of the US investment market and the differences between US and Australia. He was much more happier to take risks, and we found that all investors in the US were. So Jeff headed Red Light Investments. He sold his last company called Mercury Payment Systems for about $1.6 billion. So he had a buck or two to actually throw around, which was pretty good. And I will never, ever forget the third or fourth meeting that we had with him. He actually flew down to Sydney because he was on holiday with his wife at the time. And we sat down with him in a cafe and he looked at us and he said, okay, so how much are you looking to raise? And we said, 1.5 million Aussie dollars. We didn't say the Aussie dollars part. And he goes, is the product launched? He said, we just launched. He said, all right, would you take two? Of course you take two. All right, $2 million US. And we said, okay. So with the other angels, we managed to patch together a round of 2.2 million US dollars. At the time, with the exchange rate, that was 2.5 million Australian dollars. Bingo. You know what that gives you? One very, very happy family. It really does. But you also have to realize that when you're going out to the international investment market, the stakes really, really go up. You are now competing for the same investment dollar on the same performance basis as the best companies on the planet. No longer are you competing with a couple of Australian success stories and then the rest, and there's a major bell curve in Australia for performance of startups. You're competing with everyone out there. So in order to compete for that dollar, you really need to be on the top of your game. There's no two ways about it. So let's have a look at what it actually takes to raise money from international markets. First of all, you need to be able to service global markets. So if you can't sell to the market where the investment came from, if the investor is completely disaggregated from your market and your business model, why would he invest in you? So you need to be global, and that's what Matt said, be global from the beginning. It's really, really important. Second of all, you need to have scalability. And when I say scalability, not that you can sell to lots of customers globally. That just has to happen. But you need to be able to scale without and acquire international customers without burning a lot of money. Now, a great example of this is Atlassian. What they did is that they went out and they implemented what's called the flywheel SaaS model. So it's where you all of your go-to-market is your marketing, rather than having a massive sales force of hundreds of salespeople going out and selling. And you get people to open leads, and then you just have a small sales force converting those leads, and you focus on marketing. This let them acquire a lot of international customers without burning a lot of money. It gave them operational profitability, but also it made them very investable, as proven by Sequoia. So Sequoia invested in them recently, what was it, last year or something like that. The other thing is that you have to have potential. Now, a good way to describe potential is done by Peter Thiel in his book 0 to 1. And what he says there is that his rule of thumb is that you have to, in order to be a disruptive technology or business, you need to have an order of magnitude differentiator between yourself and the technology or business you're displacing. Our location accuracy was 20 times more accurate, so we're pretty good there. We had the potential. And that really created, like you said, that emotional reaction, that sizzle, this is something that can be really disruptive, but we also touched on the logical part. You also have to have a very quality team. Now, we were very lucky to have the founding CFO of PayPal on our board, who joined us very early on, who managed the network to get to. However, I dare say that the more impactful thing is that we had the most passionate and dedicated bunch of founders, engineers, and team members. Our constant motto was, I'll rest when I'm dead, literally. And if you're not ready to do that, if you're not ready to put in everything, don't even bother. Don't bother starting a startup, first of all, let alone trying to raise from global markets. It's just not going to happen. Lastly, you also, one thing that's really good, especially when it comes to international markets, but is true for any investments, you want to try and make sure that your product fits the portfolio companies of your investor. And the reason that's really good is because then when an investor is investing in you, they're not just getting the return from your investment, but also they're getting a leg up and an advantage for all of their other investments. You're giving them multiple returns on the investment effectively. But also, when you're taking money in that scenario, you're not just getting cash, you're getting customers. So it's a really, really good thing to concentrate on. The other thing worth mentioning is Australian government initiatives. Now, you've all probably heard of a lot of these. There's the R&D tax incentive and the export market development grant as ones that I'd single out. So the R&D tax incentive pays you 45 cents on tax time on every dollar you've spent on research and development activities. Guess what everything we do is? Research and development. Literally 45% of pretty much all of our expenditure, salaries, rent, power, computer, laptops, whatever you need, it's all at a 50% discount effectively. And the Export Market Development Grant pays for consulting, marketing, accommodation, flights, anything you need to go and develop a market internationally for an Australian product. When we told Jeff about these things, he started giggling. He couldn't believe it. He was like, well, what do you mean? Is this communism? Honestly, that was the impression. There is no other country in the world that really does things like this for Australian startups. And what that meant is that when we told Jeff, you give us 2.2 million, but that's actually like us having $3 million in the bank. That's a massive difference for their investment dollar. It de-risks their investment. So when you're talking to international investors, promote this. And if anyone says, also on a side note, if anyone says the Australian government doesn't do enough for Australian startups, they're absolutely delusional. It made all the difference for us. We've managed to raise roughly about $2.2 million in total funding, non-diluting from the government to date. So really utilize it, know it. It'll be a great advantage to operationally and when seeking investment internationally. Now, there are also a fair few risks when it comes to taking money internationally. Now, the first thing is that you need to be familiar with US investment terms. So a lot of them cross over with Australian investment terms, but there are some specific things about language, and I've seen a lot of things thrown in, liquidation preferences, non-dilution clauses. There's a lot of things you really have to be aware of, so just do your reading, do your research, and prepare yourself before you're negotiating an actual contract or signing it. The other thing is currency risks. Now, for us, this turned out awesome. We managed to raise 2.2, ended up with 2.5. Awesome. However, this can go the other way depending on the market you're getting the money from. And also keep in mind that currency is dynamic. So sometimes it'll take 2, 3, 4, 5, 6 months to negotiate an investment deal. So you've gone and said, hey, I need 2 million. And then by the time you actually close it, what you've received is 1.8 million. But you've set out a plan for 12 months with expenses that you have to cover, and suddenly you're $200,000 short. Where's that coming from? Either revenue or further investment. You're literally short that money. So keep that in mind, that you have to keep an eye on it and really pay attention to currency risks. The other one is, I've written here Delaware C Corp requirements, but in any market that you're actually going to get investment, quite often investors will say, can you please incorporate in our market? We're more familiar with the structure, etc. Now, that doesn't always have to happen, and it didn't have to happen for us. We got the investment in the Australian Proprietary Limited. We did flip to a Delaware C Corp later for further fundraising and for a whole other range of reasons. However, you have to keep in mind that it's not necessary. Investors will invest in proprietary limited companies, Australian ones. And also, another thing about Delaware C Corp, when we actually did it, it took a few weeks and a few $1,000s. It's really quick, easy. So if an investor says that's a requirement, don't be thrown off by it. You can do it. Another thing you have to keep in mind is you now have an investor in a different time zone, which means that their time zone is your time zone, but you still have to work in your time zone. I don't sleep very much these days. So it also means that you have to travel a lot. So and have really good communication with the investors. It's very, very important. But also as a part of the traveling, sometimes it necessitates a relocation. So unfortunately for me, that meant that my co-founder Emil, he had to move to San Francisco. He's been living there for a while now, and we have an office in San Francisco. Our sales and marketing, everything is there. It's where most of our pipeline of customers is coming through. So he had to relocate there, not necessarily for the investment, but the investors were very happy that it actually happened. So and it lets us keep up communication with the investors as we go along. Lastly, as already mentioned, if you take international money, you are now competing on international standards. This isn't just international standards in performance, but also reporting, in the stats that you're building. Your company just has to be the best of the best. And when we took international money, the requirements for us, we felt it as founders, it just went up. We just had to be much sharper, much more diligent, and put in a lot more effort. So keep that in mind, that's just going to be a reality. So to summarize, in Australia, it's easy to raise a seed round. It's possible to raise a VC round with a lot of traction, but relatively difficult. In between is the valley of death, and it kills more Australian startups than any other thing in our current ecosystem. You may need to get international funding to get through the valley of death, which is the most common time you'll actually seek funding from global markets. Network to get to those investors, and it is possible to get to those investors. Make sure that you understand the risks, the standards that have to be applied to your business, and all of the other associated risks. But more importantly, go and build the best goddamn company the world has seen, and you can raise anywhere, absolutely anywhere. Thanks, guys.
Genuinely, that was awesome. Thanks, Philip. Do we want to take any questions from the audience?
Philip, just once you list overseas, and probably two-part question. Once you list overseas, do you lose access to the R&D rebate? And then if you move, and then when the international money comes in, do you still claim on that because it's spent in Australia?
It is. So it's where the expenses realised. For us, all of the expenses realised here. We've got a couple of sales guys who obviously can't claim anything of what they're doing is an R&D, or our marketing is an R&D overseas. But here we have 11 developers, CTOs, everything. This is where the research and development happens. So you just have to justify where the expenses incur.
You spoke of your initial estimates blowing up. Is that to achieve scalability, or is it?
So our estimates blew up for a couple of reasons. One, we were just delusional at the beginning. Even to build the tolling platform would have taken a lot more. But also we made a massive pivot, because for tolling, we could have released it as a pilot on one toll road with a customer, and sort of bit by bit, and sort of scaled up from there. But when we started looking at powering a whole new generation and being a new standard of location services, suddenly that meant, well, you need to, doing maybe a million triggers a day isn't enough. You need to do 1 billion location-based triggers a day. Can you actually support that? Suddenly we went from, we're not just running tolling, but rather, hey, we can understand if a person is in their front yard versus their backyard. Privacy concerns went absolutely crazy.
Can you talk about balancing that tension between kind of like pitching the idea, but then also not really having your IP kind of sort of through that timeline when you pivoted, realising that you kind of had something that suddenly was very protectable?
Yep, so we were actually in the Innovise Accelerator program in Adelaide at the time, and this was just the first 3 months of the company, so it was really, really early on. When we started the company, my co-founder quit his very cushy job in Canberra. He was a cybersecurity and economic policy advisor to 2 prime ministers, and he said, hell yeah, I'll join your startup. I was like, really? So we moved to Adelaide, we jumped into the Startup Accelerator program to get some experience, and we kept pushing on the tolling platform. And we had the contact in Seattle who introduced us to a few investors. He was a mentor of the program, that's how we got to him. And he sat down with us and he said, tell me what you do. We said, we do high accuracy, low battery drain location services in order to power it. No, start again. We do high accuracy location services without battery drain. Stop. That's what you do. And that was a crystallizing moment for us. And then we said, oh, holy crap, are we actually better than Apple and Google? And it turned out we actually were. But the funny thing is you constantly get doubt on those things. So every time I go to an investor meeting, every time you speak to anyone, the question that comes up is, why isn't Apple doing this? Why isn't Google doing this? And that's the nature with disruptive startups, and that's the nature with big visions. When you're trying to do something big, it's never easy, and people have a million doubts. So you've got to believe in yourself. You really got to back yourself.
Where did this idea come from? Were you part of this industry, or were your co-founders part of this? And how did you build that trust with an investor to say, this is an idea that I can recommend or flash-based?
So when we started, I come from Europe originally. There was a system there where you could pay for on-street parking, so pay by phone. What's here now, that was via SMS past decade in Europe. And I came to Australia and I said, well, how about I actually build that just through an app platform and sell to councils here? And that's when I started preparing, researched the accelerator program, all of that. And then just before I was about to apply, found that Pay by Phone came to Australia from the US and I sold it to many councils and said, okay, that idea's gone. And then a moment of inspiration after a few too many drinks at my uni bar, sitting at the lawn, and I said, well, what else can I actually do with payments and transport? That's where the tolling platform came in. But as you can see, the truth of it is that it was pivot, change. And I think that's probably the biggest power behind startups and the biggest strength that we have is that we can actually change very rapidly. If you look at, if you're competing against a massive company, it takes 16 months, 14 board meetings, and God knows what in order to change pricing. We do it before I brush my teeth in the morning. We change pricing. So you have to pivot, have to be flexible, and that's what we did. We kept fighting, kept changing, kept researching, understanding the market until we got to a point where we're like, yes, we have a massive gap in the market. We have a massive advantage. Let's now hammer down on this.
Do you ever have problems when you pivot with like your investors suddenly realizing they're in a different, you're in a different market space to what they initially thought, or like anything like that?
So you need to have trust with your investors. You need to have a good relationship. If people are, there are investors that are sharks out there, just want results, and they'll burn you as soon as something changes. They feel insignificant. When I say burn you, not harm your company, but just say, sorry, I'm not going to talk to you, provide advice, or give you any more money later down the track. So you have to have a good relationship with your investors. That's really important. However, as you keep going along, the pivots get smaller and smaller. For us, the first pivot was, the first pivots were massive, going from tolling to a location-based services platform. Now the pivots are go-to-market strategies. So for instance, our latest one that's produced ridiculous results is that we went from direct sales, where we used to sell the SDK directly to enterprises, which was an 18-month sales cycle and incredibly painful. We flipped that to a channel sales, a model where we work with platforms and they on-sell the technology for us, seeing 100% month-on-month growth of the usage of the SDK since then. So it's more tactical pivots rather than changing the whole company. But if I was to change everything right now, the company would be over.
So you said that you got to the value of debt after you'd already kind of had or raised $1.5 million. How did you, when you started out, was it just an idea? Did you get some MVPs along the way to kind of show to investors to kind of get to that point? Because that part is not all my place.
Yeah, so it's all about validation and understanding of what you're doing. So and communicating that validation to your investors. So the first thing that we did is we said we have two co-founders with no technical experience, and we want to raise investment. Generally, some people try and do it off spreadsheets and drawings. That's great, but this is a highly technical product and highly technical solutions. So we actually found a application development house who assisted us at the beginning with just creating a very, very simple prototype. So we just said, this doesn't have to work. It has to just prove out one bit of IP, but it doesn't have to stay alive, doesn't have to have code control, doesn't have to look nice. Hell, it doesn't have to be a usable product. Just prove out what is right now 1/7 of our IP, just prove out that actually works. And we managed to get geofences from 100 meters to a 5-meter geofence and trigger an action when you walk in that. And that was enough where we could put it in the hands of a customer and say, would you use this in your application if it works? If we built it, yes, I would. And same for investors. Would you back this in order to build it? Here's the proven IP. We also filed a patent around the technology, which gave us some kind of assets into the company at the beginning, even though a lot of people will debate the value of patents. Are they valuable? Are they not? Well, that first one that I came up with literally on my uni lawn is actually just hitting full granting in the US right now, $30,000, $40,000 in filing fees later, but it's actually valid, and it actually gave us a substantial asset at the beginning to back it. So it's all about validation, bits and pieces, being able to demonstrate something and doing it incrementally. There's no one who wakes up in the morning and goes, I've got an idea, and then exits for $50 million. It's blood, sweat, tears, constant pivots, constant validation. And that's one of the biggest things that I tell a lot of startups that I mentor. Unless you're ready to bleed for your company, don't start it.
My question was about IP. So you say that you have a patent. How important it was for the investors, your patent, and how well you can protect it?
Yep, so we have 7 patents at the moment. First one's hitting full granting, others in various stages, provisional PCT. We spend a lot of money on it. It depends highly, I think, on your company. So, for instance, if you have an Uber, there's nothing to protect there. It's not a novel step. It's not inventive. There may be some loose correlations, but you really need some deep IP in order to make it protectable. So, first of all, focus on if it's appropriate for your business. Second of all, for our investors, it was very important because at the beginning, when you try and do something disruptive and it's a pipe dream, any little bit of solidity that you can give them, any bit of assurance that your potential is going to be valuable, and also even if we didn't manage to monetize the company, let's just sell the patent portfolio and you can actually get some returns from that for that. So it de-risks it, gives them a sense of security and a sense of, hey, if they're filing patents, if patent attorneys are working with them, looking at this, going, hey, this is novel. Well, guess what? It's not just two founders on a couch going, hey, trust us. It makes a big difference.
Awesome, guys. That's Filip from BlueDot Innovation.